Good afternoon, and thank you for inviting me to represent the Institutional Money Market Fund Association at this year's EACT Summit. I'm really delighted to be here again and would like to say how much we appreciate our long-standing relationship with the EACT and value the opportunity to engage with corporate treasurers across Europe. For those of you who are not familiar with IMMFA, founded 24 years ago, we're the only trade association in Europe dedicated to money market funds. Our core objective is to promote and support the development and integrity of the short-term money market fund industry. We do this by engaging with policymakers, regulators and organisations such as the EACT, educating investors and providing a centralised point of contact and expertise. Our members consist primarily of large asset managers, but also firms providing services to money market funds, such as fund administrators, rating agencies, and technology providers. You'll be familiar with many of the names of our members, and indeed you can find a list of them on our website by clicking on the QR code shown here. IMMFA funds are institutional as opposed to retail. They are domiciled primarily in Ireland or Luxembourg, and importantly, from an investor's perspective, all have one or more AAA rating. IMMFA currently has over €1 million equivalent under management in 3 currencies, US dollars, followed by sterling and euro. As illustrated in these pie charts, IMMFA funds are sold globally to a wide range of investors. Europe accounts for over 80% of our distribution, with funds sold to countries including Germany, Benelux, Ireland, the Nordics, and the UK. Corporates account for almost 1/3 of the investor base. Other investors are asset managers, pension funds, insurance companies, and public sector entities. So the corporate investor base plays a major role. We know that many corporates value money market funds as a cash management tool, and in particular the LVNAV structure and its key features: stability, same-day liquidity, and cash equivalents. Those corporates who are issuers and will also appreciate the fact that money market funds contribute to their funding through the purchases of ECP. So how does a money market fund compare to a deposit? Well, a money market fund has many features akin to a traditional bank deposit, and in terms of simplicity and convenience of use is very similar. But it has additional benefits. In contrast to the single credit exposure of a bank deposit, money market funds offer a diversified, actively managed basket of credits based on a broad range of highly rated investments. Same-day liquidity is a key requirement of most cash managers. Both overnight deposits and money market funds provide same-day liquidity. But a money market fund is more flexible than a deposit, which is likely to entail a penalty fee if broken. Money market funds are required to hold minimum liquidity buffers, which ensure they have sufficient cash to pay out daily redemptions. For short-term funds, these are currently 10% in daily liquidity and 30% in weekly liquidity. The AAA ratings of an IMMFA money market fund, which are much higher than a typical bank rating, reflect the high quality of underlying assets. Money market funds also offer the operational ease of a single transaction compared to multiple deposits. Money market funds can offer potentially better returns than a bank deposit due to their longer duration and the fact they are actively managed. And last but not least, money market funds also allow investors to effectively outsource credit expertise and operational resources. If we look at how money market funds are performing, this chart illustrates the breakdown of total money market fund assets under management in Europe, which at the end of 2023 were €1.7 trillion equivalent. As you can see, the industry has grown very strongly. In fact, it's almost doubled in the last 10 years. With over €1 trillion equivalent, IMMFA funds account for approximately 60% of the total in 3 currencies, dollars, sterling, and euro, shown here in amber, green, and grey. The other 40% non-IMMFA is shown in blue, which is primarily the French VNAV market. European money market funds are currently regulated by the Money Market Fund Regulation, or MMFR as is known, which was introduced in 2017 to enhance resilience. MMFR created the new fund types divided into two categories, short-term and standard, with short-term being the more conservative. Within the short-term category, we have two fund types, which operate with a stable as opposed to a variable NAV. The public debt constant net asset value, PDC NAV, which invest in government assets, and the low volatility net asset value, LV NAV, which invests mainly in private debt. You can see here that IMMFA funds consist overwhelmingly of stable NAV money market funds. Over 78% are LV NAVs and 18% PDC NAVs. The remaining 3.6% of assets under management are variable NAV, primarily short-term variable NAV. As you can see from this chart, IMMFA assets under management, shown here in euro equivalent, have grown tenfold since 2001, illustrating their continued investor utility and confidence in the product. So have there been any regulatory developments impacting money market funds since last year's EACT? And what might these mean for corporate treasurers? Although market events in recent years have demonstrated that the current 2017 regulation has definitely increased overall resilience, the COVID liquidity crisis led to a great deal of scrutiny of money market funds and resulted in a series of further proposed reforms. It also revealed an area where the regulation did not work as intended. This was the link between minimum liquidity thresholds and the possible imposition of fees and gates. Initially, the Financial Stability Board proposed a wide range of possible reforms, including increased liquidity levels, delinking, which is removal of the link I just mentioned, various redemption fees to prevent outflows, restrictions on what assets could be held, and lastly, but most controversially for us, removal of the stable NAV. We at IMMFA were in favour of delinking against significantly higher liquidity thresholds and very much opposed to prohibition of the LV NAV. The US was the first to propose and consult on these proposals and is now in the process of implementing higher liquidity levels, delinking and a redemption fee structure. In Europe, after a number of reviews and consultations, the European Commission published their long-awaited review of the money market fund regulation last July. Then in December, the UK's Financial Conduct Authority, the FCA, in conjunction with the Bank of England, launched their consultation, which closed in March. I'm pleased to say that the European Commission's conclusions were largely positive. In particular, they indicated that the existing money market fund regulation enhanced financial stability and had successfully passed the test of recent stress episodes, that money market funds had withstood redemption pressures, thereby demonstrating that safeguards worked, including the ability of CNAV and LV NAVs to maintain their stable NAVs, that there was scope to increase resilience, notably by delinking, the removal of the link between liquidity thresholds and fees and gates, that money market fund resilience would benefit from the EU harmonised rules on the use of liquidity management tools, that there are structural problems linked to the broader short-term funding markets which should be further assessed. So in short, this meant that there would be no proposed revisions to legislation at the present stage. The LV NAV would continue, so good news compared to where we were a year ago. Turning to the UK, the authorities have been making their own assessment. The FCA's recent consultation has a number of real positives. They also propose delinking. They suggest that each fund should have at least one liquidity management tool to be used at the discretion of the manager, which we agree with. They propose retention of the LV NAVs, but suggest enhancing resilience through reasonable measures such as additional operational resilience. And they raise the subject of using money market funds as margin collateral, something we've strongly advocated. However, the FCA has proposed significant liquidity increases for all fund types, and notably would make liquidity levels the same across all funds. We think the levels they suggest are too high. In the case of stable NAV money market funds, that's PDC NAVs and LV NAVs, it would mean an increase from 10 to 15% for daily liquidity and from 30 to 50% for weekly liquidity. VNAVs currently have 7.5% daily and 15% weekly, and would likewise move to 15% and 50%. An important point to note is that any measures implemented in the UK will also impact all EU domiciled money market funds intended to be sold or marketed into the UK, because to do so, these must be deemed equivalent. Since almost all IMMFA funds are domiciled in the EU and 40% are sold in the UK, this would have an enormous impact. Also, it's likely that the UK's conclusions, along with the FSB's recent thematic peer review, for instance on liquidity levels, will influence the EU debate. Indeed, it's now looking likely that the next Commission, commencing at the beginning of next year, will reconsider the money market fund regulation. So what are the implications for you as corporate treasurers? Well, firstly, there is greater likelihood of reforms, including delinking, which is positive, and also increased liquidity buffers. Increased liquidity levels will have an impact on investor yields. While we understand the need for a discussion around what are the most appropriate levels, we think those proposed by the UK, in particular the 50% weekly liquid assets, are unnecessarily high for a number of reasons. The fact that the EU might open up the regulation also means that the threat to the LVNAV has not gone away. The LVNAV accounts for 46% of the total European market, so prohibiting it would have a huge impact on investor choice. Those investors who prefer a stable NAV would be limited to the public debt CNAVs, and these are scalable currently only in dollars. For others, it would mean a forcible move to VNAV, which for some could have costs and consequences in terms of systems, reporting processes, and accounting treatment, including implications for cash and cash equivalents. In terms of timing of any possible reforms, the earliest changes are likely to be 2026 or 2027. However, meanwhile in the EU, the next Commission will bring new stakeholders. Raising their awareness of the utility value of money market funds will be key. It's therefore critical that we continue to engage, and this is where your role as corporate treasurers is vital. Our close cooperation with the EACT has been very important to get us where we are in ensuring your voice is heard. But the battle is not over yet, and we will need to continue to encourage investors and issuers to make their voices heard to ensure that regulatory changes are targeted, proportionate, and work for you. Thank you.